In the spirit of reconciliation, we would like to first acknowledge that this podcast is recorded on Treaty 7 territory. We would like to take this opportunity to acknowledge the traditional territories of the people of the Treaty 7 region in southern Alberta, which includes the Blackfoot Confederacy, comprised of the Siksika, Piikani, and Kainai First Nations, the Tsuut'ina First Nation, and the Stoney Nakoda, including the Chiniki, Bearspaw, and Goodstoney First Nations. The city of Calgary is also home to the Métis Nation of Alberta, Districts 5 and 6.
Hello, and welcome back to the Hearsay podcast, a joint project between Pro Bono Students Canada, University of Calgary chapter, and CJSW 90.9 FM. This is a podcast where University of Calgary law students discuss a variety of legal topics with a plethora of professionals in the field. We'd like to emphasize that the information you hear today is legal information and not legal advice, as we are law students and not lawyers. This podcast is purely for informational purposes. If you do require legal advice, please consult a lawyer, as there is no substitute for a professional. My name is Maya Ebron, and I'm here today with my co-host Harper Kennedy. We will be speaking about the decline of public companies and the issue with private equity with Dan Wilson.
Dan Wilson is the Associate Dean and Chair in Business Law and Regulation at the University of Calgary Faculty of Law. Before returning to academia in recent years, Dan was a corporate lawyer, senior business executive, and serial entrepreneur. Dan previously served as a law clerk in the Supreme Court of Canada, was an associate at a national law firm, a partner in a Calgary-based corporate law boutique, president of 2 junior public technology companies, an executive in a variety of multinational businesses, and co-founders of several startup business ventures. Dan has previously been a guest on the Hearsay podcast discussing entrepreneurship and the law, and we're so excited to have him back today. With that, Dan, welcome to the show. Today, we're going to be exploring the decline of public companies in the market and various issues with private equity. So I'll kick this off with a broad question. What is Canada's relationship with its public capital markets, specifically in relation to other countries in the developed world?
Well, that is an interesting question because Canada has a very unique relationship historically with the public companies. In the U.S., public companies you would normally start to consider as a growing company, a public option when you hit a market capitalization. Well, let's go historically. Let's say 15 years ago. You would have looked at maybe $250 or $300 million. Now that number is probably $1 billion. In Canada, we use public companies in the junior markets. And so I'll just take a step back. We have a junior market and we have a senior market. The senior market is comprised pretty much of the Toronto Stock Exchange, the old, long-standing exchange that's been around for 150 years. It absorbed the Montreal Stock Exchange, which was the other old exchange. So we basically just have one exchange. But on the junior markets, we've historically had a competitive landscape that is comprised of regionally based exchanges that service local industry at a stage that is far more entrepreneurial than exists in other countries, in particular and compared to the U.S. And so you would have companies going public on the junior side of the market with valuations of $5 million, $10 million, $20 million. Now there's fewer of those now, but the Canadian markets were always unique in that. And why was that the case? Well, it's because Canada has proportionately less venture capital. So there's largely 2 sources of institutional capital. Institutional capital being pooled capital that's invested in companies. And the two segments of the market are private equity and venture capital. And the distinguishing feature between those two is private equity usually invests in cash flowing companies that have already proven their business model and are making a profit. Whereas venture capital invests early on. It invests in concept companies, sometimes even pre-revenue. So much earlier in the stage. Now, Canada has only 1/4 the amount of venture capital invested on Canadian companies on a per capita basis than the U.S. does.
Wow.
So that's a huge reduction in available capital for startups. It's much harder to find startup capital in Canada. You have to look harder. You have to look farther. You can generally only finance if you're in the right market at the right time. And so what has filled the gap for that has been our junior public markets. So you can think, and many people often do characterize the Canadian junior public markets as public venture capital because they're investing at a stage where in the U.S. you would never even consider taking a company public. Their scale is so much larger. In Canada, people will be investing in concepts, in early stage development, and historically, the biggest consumer of capital was always the resource extraction industry. And so the junior markets in Canada have a long history of financing startup extraction companies, which in oil and gas would be exploration stage companies, and in mining would also be exploration companies or mining exploration companies. And the ratio of success in mining companies might only be 1 in 30 or 1 in 40. There's not a high likelihood of success, but when they do hit, they hit on huge multiples. And so you're really playing a lottery market as an investor. But Canadian junior markets were very attuned to that and had a long history of financing those startup companies. And frankly, they've been a huge part of why Canadian resource companies have very much outpunched. We've punched beyond our weight class is the word I was looking for, or the phrase I was looking for. We've done much better in resource extraction than we should have as a country that's historically very small population-wise, because we've had that source of capital that has been willing to take risk in the public markets at much earlier stages than venture capital would. Venture capital, you can't finance a startup mining company through venture capital. They aren't interested in that risk portfolio. Retail investors in Canada have been. So all of that to come back to the question to say public markets, the junior public markets, have historically had a far bigger part of our economic story than certainly in the U.S.
Right.
Now, the question was other industrialized countries. Every country kind of has its own unique mix. The United Kingdom was historically very much like the U.S. in type of scale, although they learned from us, I would say, and they have adopted the AIM market, which has been quite successful as a retail-based, smaller equity market, but more of a junior market. Australia doesn't have junior exchanges. They have a single large exchange, Australia Stock Exchange. But their senior exchange has a history of doing more junior level financing as well. So the UK and Australia are closer to Canada, but Canada still, by I think a significant margin, has relied more heavily on the junior capital markets as a key part of our overall, economic strategy than any of those other countries, and by orders of magnitude compared to the U.S. We just simply don't have the institutional private capital at the venture capital side to make to do near what the U.S. does. The U.S.'s innovation economy is almost all based off of venture capital,
right,
where ours was largely based off of the junior public markets.
Yeah. So kind of building on that, what do you think the role private equity is playing in taking startups into mature companies? And what are your thoughts on the argument that this is robbing average Canadians of the opportunity to participate in homegrown success stories?
Okay, well, I'm going to split that question. When you say private equity, I'm going to talk about private institutional capital in both structures,
okay, yeah,
in both venture capital and private equity. So private equity, we still only have a quarter of much in the U.S., but we have orders of magnitude more than we did 30 years ago. So whereas venture capital was very hard to find 30 years ago in Canada, it's growing by leaps and bounds. It just still is not at the scale of the U.S.'s. Private equity has grown even faster. Again, private equity being one step up in the food chain and investing in companies that that are already cash flowing in their business plan. So the answer to that question, I have to take a step back into securities regulation, which is in Canada, we have a very interesting structure that has not evolved to the degree that other countries have evolved in this way, is our system of securities regulation grew up and evolved at a time when the public markets were the only game in town for large-scale financings. Institutional private equity didn't exist. So there was no such thing as a one-person or a two-person company. They weren't intended for that. They were intended to do big things for the Industrial Revolution, for starting new enterprises in the colonies, like, in Britain. Mm-hmm. These were mechanisms for accumulation of permanent capital. And so there was no alternative. If you wanted to raise capital, you raised it from multiple sources. You had to comply with whatever the rules of the day is. The earliest private institutional capital really started to be gathered only after the Second World War. The recognition of the private company form, like the idea that you could have a company with only one shareholder,
right,
and you're just creating a synthetic person to segregate liability and create some of the other advantages like perpetual existence and stuff of the corporate form. That came in North America in the early 1900s. In Canada, it came in, I believe, in 1907. In Ontario was the first recognition. But there was still, from 1907 up till the 1950s, corporations were only being used for essentially sole proprietorships or partnerships in a corporate form, or you were setting something for the public markets, because if you wanted to go raise significant pools of capital, the public markets was the only game in town. They simply didn't have access to these large institutional pools of private capital. That changed in the early 1950s, right at the end of the 1940s, under U.S. Changes in regulation that allowed private investors to invest through institutional structures into private companies. Until then, individual investors weren't allowed to invest, in private companies en masse. That allowed high net worth individuals to pool their capital and to invest in the private structure. What was the advantage? A massive reduction in the cost of compliance. Mm-hmm. You don't have to have audited financial statements. You don't have to give away your trade secrets. You don't have to put your material contracts in the public domain. You have much less litigation risk. We have class action securities cases in Canada and the U.S. You have so much less risk. You have so much less distraction. You have so much less cost of operating your company. So all of that to say is nobody thought, like when the regulatory changes occurred initially that created the pools of private capital, the public markets were so entrenched as the dominant source. No one ever conceived of a day that the private markets would actually start to cannibalize the public markets and put them at risk of having significance. And it's only in the last 20 or 30 years that that's started to happen. So the peak of public listings in the U.S. was in 1998. In Canada, it was a decade later in 2008. And if you just look at the trajectory of the money that's been invested into private institutional capital, it's gone up by orders of magnitude even in the last decade. I'm talking like multiples of what it was previously, each few years. And so those numbers became big. And now as a company, if I wanted to go out and raise $100 million, in 1975, there was only one option. Now I have competitive bids from 40 or 50 private equity institutions if I'm a really good deal competing, and I don't even have to do the deal at a significant discount to the price I would get in the public markets. In fact, sometimes it's even at a premium. So I say this to say is, as private institutional capital has increased in scale, it has become a much, much bigger player in the markets to the point of where it is nearing equality in terms of the number of dollars invested in the public markets and through the private markets every year. And a lot of startup companies are saying, why on earth would I go through the hassles of becoming a public company and taking the risks and having to report my earnings and having to do all of these things, and also, by the way, manage 5,000 shareholders, of which 20 may be activists, and they may have no interest whatsoever let's go to the classic. We're in Alberta. Let's say you're an oil and gas exploration company. You would assume that your shareholders want you to find oil and gas. Well, except for the activist investors who actually don't want you to find oil and gas. They hope you never produce a barrel of gas. They simply invest a very small amount so that they can agitate for you to get out of the oil and gas industry and actually fail. Why would you sign up for that when the alternative is to get private capital without any of, now you do have one shareholder and you have to keep that shareholder happy, which if that person is unhappy or the shareholder is unhappy is a challenge. But if you're aligned in making money in oil and gas exploration, that's a whole lot easier road and a less expensive road and a less distracting road. And so what we have seen, frankly, is the private markets are cannibalizing the public markets, and sadly to the point where many people, myself included, would say most of the deals that go public today, the vast majority of the deals that go public are only those companies that cannot access private capital. Meaning that the private equity funds or venture capital funds are saying, we don't like your risk profile, your business plan's not sound enough for us, and therefore we're staying away from you. And those companies have to go public, and then they do it on an overly promotional basis, trying to sell their story, trying to create buzz around the stock. And it's led to, if you look at exchanges like the CSE, the overall return on the CSE has been negative 85% since they started tracking the CSE index in 2015, I believe. That's not a very attractive return for the public investors. And so it runs risk of, becoming a lemons market, and being perceived as a lemons market, which is a lemons market is a place where the good deals, avoid, and only the deals that can't get funded in an alternative environment show up. I don't think we're there yet, but we are at risk of ending up there. And that's certainly, been the financial returns over the last bit. So answer to your question, Maya, the answer is the private equity markets, and in particular, and the venture capital markets to a lesser extent, have superseded and overwhelmed the public markets and largely replaced them for the best and the brightest young companies. And where have the booms been in, call them booms, but they're not booms by traditional standards, but by recent standards. We're like, oh my goodness, we had 30 IPOs, it's a boom. They're in very highly priced tech deals. They're in cannabis, and they are in crypto. These are highly speculative, high risk, high return things that private equity and venture capital wouldn't touch largely, and so they were forced into the public markets.
That's really interesting. Just going off of that, what do you think the advantages are for companies to go public?
Yeah, like in this market, why would anyone, other than have needing to, just because they're denied venture capital and private equity funds, why else would you encourage or tell people to go public?
Am I allowed to answer that I wouldn't?
Yeah.
Because that is my answer.
Okay.
As
Fair.
things are currently stacked, I would never advise a company to go public if they had a realistic private financing alternative. And I could speak for literally a day on the potential downsides associated with being public. And the upsides are extremely slim. Because it used to be, when I started practicing, which I know you guys think was a long time ago, but seems recently, the rule of thumb would be that your valuation was going to be half in the private markets what it would be in the public markets.
Right.
And so if I had a company and I wanted to raise $100 million, I'm giving twice as much away to raise it in the private markets as I am in the public markets. That delta has shrunk and shrunk and shrunk to the point of where it is now sometimes negative. And so you're talking about incremental valuation enhancements in the public markets. Now, in some areas, they're larger, but overall, it's no longer double. It might be 10, 5, maybe 15% in a valuation premium if you're public compared to what you would get valued at privately. And then you have all of the costs to offset it, all of the risks and all of the distractions. And frankly, the distractions are a bigger headache than the costs and the risks, because you spend so much of your time as a senior officer of a public company dealing with being public as opposed to building a profitable business. None of the elements of being public, reporting to your shareholders and dealing with your ESG compliance and, add your scope 1 and scope 2 emissions disclosures and everything that gets layered on. And now your mandatory DEI, where do you meet on all of these categories? And, next year it'll be something more. None of those things make money in a company. They are all costs of being public. So, the distraction of having your underwear, hanging on a laundry line in front of the whole world,
right,
and then having to account for it takes a lot of time of senior management. When I did my dissertation analysis on this specific topic, I had CEOs tell me that they spent 70% of their productive time managing the public company and 30% managing their business to be profitable.
Yeah. Well, on that, how do you think this avoidance or reluctance to going public connects to, our very intricate and complex regulatory and governance systems in Canada, surrounding securities?
It's a part of it. So, as I understand your question, it's what part of the aversion to being public can we lay at the feet of our regulators and our system of securities regulation?
Yeah, because I think the regulation aspect is important. People in the public want to know that there's checks and balances and transparency at some level. So,
yep. And there's very strong rationales in favor of each of those pieces of regulation. The investor rights lobby, which is always arguing for more regulation, are not people who are inarticulate or fail to, recognize basic principles of finance. They have well-articulated and well-thought-out reasons why they argue for greater disclosure and greater regulation. And they equate largely enhanced disclosure with a quality of governance, corporate citizenship, all of the the elements that are embedded within ESG. They believe that increased regulation is the answer to better governance in every way. It's the answer to having better corporate citizens, having our corporations more aware and responsive to climate issues. It's the answer to everything. So the trend has been increased disclosure, increased disclosure, increased disclosure. Every piece of increased disclosure has a cost associated with it. And so the question is, how big are the increased disclosures, the complexity, the distractions, the costs? How big are big of a factor are those things in the overall decline in the public markets, of the increased aversion of startup companies to go into the public markets? Well, that's what I did my dissertation around. I think I did the first empirical work ever done on that. And a lot of people, especially people in the compliance departments of companies, want to put the whole problem at the foot of the regulations. The answer is they are significant, but they are not everything. There are things that operate independently of regulation. The increase in the availability of private capital is not a function of increased regulation. It's actually a function of decreased regulation back 25 or 30 years ago, and then several continuing changes, by the way, almost always under Republican governments in the U.S., that have increased the access of retail investors and private institutional investors into the market, increased the ability to raise capital from people. So that's an independent factor. That's a big factor. The immediate result of the increasing amount of private capital is the reduction in the valuation differential. That's a big piece. So as soon as the valuation differential declines, my willingness to accept the cost of being a public company goes down. It has nothing to do with additional regulations imposed on public companies. It's just a separate issue that happens to coincide in time with the increase in public disclosure, over a period of time. What else is in there? Technology is a huge player. and not in just a single way. In one way, so one of the major theorists on this issue is a professor named Jay Ritter from the University of Florida. His principal theory is called the technological change hypothesis, is that the pace of change of technology makes companies who are technologically based obsolete so quickly that very few are willing to risk becoming public and basically trying to continue to ride ahead of the wave of technological change. Some have done it successfully. Apple, the FANG companies, right? Most get eaten up. Like, you may have a technological lead today as a startup company. Well, guess what? Apple may be investing in the same thing secretly, and they just announced a product that made yours obsolete. So because of the knowledge of that, it makes so much more economic sense on a risk-adjusted basis to get a lead and sell out immediately rather than go public and take the risk of being able to stay ahead of the curve. So if you are successful, if you get a lead, monetize it, get out, and then go cash your check and maybe you start again lately. So that's one element of technology. The other element, and this is, in my opinion, the most misunderstood and the most underappreciated elements of the aversion to the public markets, is the role of intermediation, professional intermediation, and the use of technology in intermediation. Intermediation means using professional entities like brokers, investment dealers to advise you. And our economic model, or our securities model, requires that if you are an unsophisticated investor, if you're just, Mary Jane on the streets, that you, in order to access the markets, the private markets, you must operate through an intermediary because they deem you not to be sufficiently knowledgeable that you're not going to get taken advantage of. Well, the intermediaries also engage heavily in the markets on a trading basis. So if you are a company, maybe 90 to 90% of the trading in your stock as a public company is not in the hands of shareholders who care what you are going to do 5 years from now. They have no desire to know what you're even going to do 2 years from now. They are program traders, they are day traders, and what they're trying to do is get in and out of your stock on the upticks and the downticks based on momentum plays, and to the extent that rumors come in that drive the stock up or down, so much the better for them because they make money on volatility. At the same time, they're using very sophisticated program trading where nanoseconds and milliseconds make a significant difference in outcomes, and they are clipping extremely small coupons, meaning if they make 1/4 of a cent on a trade on a share, that's enough for them because their costs, we've managed to create systems where the cost of trades are so small that they can clip very small coupons. So if I'm a retail investor in the market, every time I go in and make a trade, I'm competing against all of these AI-based, robo-trading and automated platforms in which tens and hundreds of millions of dollars have been invested that are proprietary to the intermediaries. How can I compete against that? And for the company's looking at this and going, that adds no value to me. It adds none. What if I, as a CEO, want to say, you know what? We're going to make a strategic decision, and we're going to invest in this new path, and we're not even going to know whether this succeeds for 5 years. And if it succeeds, we're not going to get the economic return for 10 years. That is so far beyond the horizon of the new class of professional investors that it actually discourages innovation over the long term, and productivity and competitiveness. Because you can't afford to wait for 10 years. You're going to get fired in 2 years if you don't deliver the results. So all of that is combined in a term we call short-termism. Reporting on quarterly results. Well, I'm a company, and the analysts who are, external people just looking at my company from afar, well, they're looking carefully, but they're not inside my company, say that I'm going to make $1.32 a share on EBITDA, and I make $1.27. And my stock trades down by 20% because I missed the analyst targets. That happens frequently. Well, who were the analysts to say that I was going to make $1.32? And if I make $1.27 instead of $1.32, why would I trade down by 15 or 20%?
Right.
So you have this whole, and by the way, that was one of the factors that when I did the empirical analysis proved to be unduly and unexpectedly weighty in the minds of the C-suite people, that they hated managing to the analyst targets. Because they're like, who are these people to predict what I'm going to earn? And if I make a decision that is not as profitable this quarter, but is going to make money 5 years out, that the analysts do not, frequently pick up on it. Certainly the shareholder bases in the program trading era don't. So again, it's another frustration. So I've given you like 4 or 5 different things that all coalesce around to make the public markets less attractive for the decision makers who have a decision on whether to go private market or public market. Because if the public markets simply become the remnant of the companies that couldn't get financed in the private markets, then that is a very sad day. And that's a path we're headed down. So, answer to your question, that last piece was free. The answer to your question is increasing securities regulation is a significant piece, but it is only one of 6 or 7 different large-scale factors that have combined to make it very, very tough days, that make it very unlikely that a person with a decision will ever choose the public outcome.
Yeah. Well, thank you so much for coming on and talking about this. This was so interesting. And I feel like we learned a ton. And I think everyone that listens will also learn a ton. So thank you, Dan, for coming.
Thank you. It's always a pleasure. Happy to come back. Anytime you'll give me a pulpit and a congregation, I will be there.
That concludes part 1 of our interview with Dan Wilson. You are listening to the Hearsay podcast. We are proud to present you with legal information, but please remember that this is legal information and not legal advice. If you require legal advice, please consult a lawyer. The Hearsay podcast is a joint project between CJSW 90.9 FM and Pro Bono Students Canada, the University of Calgary chapter. If you'd like to hear more podcasts like this, the Hearsay podcast can be found on Google Podcasts, Apple Music, Spotify, or wherever you get your podcasts. Thank you for listening, and we'll see you next time.